All right, so in this video, we're going to look at some of the principles involved in evaluating a company and what a company's worth, right? So, the core subject is value investing, and so as we talk about evaluating a company from the standpoint of an investor, what I always want you to have in the back of your mind for this course is that these principles that you'll use as if you were an investor will shed some light on what you should be looking for as far as what is genuine value for your company, right? So this class rather is designed to be an investment class, but I know that there's many of you maybe that won't ever be involved in the stock market, or if you do, you don't want to do it actively. That's fine. There's still value for you in this class because you're going to learn what does a healthy company look like. And so any manager, any small business owner is going to want to have this information because these investors have really spent a lot of time trying to understand what makes a company work, right? And so if you can understand this kind of language, and predominantly we're going to be looking at the numbers, right? The financial health of a company. You always want to take in, there are two things if you're going to trade. There's technical analysis, and then there's fundamental. Technical and fundamental, right? Technical analysis means that you're looking at the numbers, in a pure stock market kind of way. Technical analysis would be looking at the chart or something like that. It would be looking at ratios. It would be looking at their financial information. Fundamental analysis looks more at what is going on in the context of the company. So fundamental analysis of a company might be what is their leadership like? Did they just hire a new CEO? Fundamental analysis might be what is their industry doing, right? If you were selling VHS tapes and you're trying to evaluate a company rather that sells VHS tapes 20 years ago, they might have looked good, but then about 15 years ago, all of a sudden they're not looking so hot, right? And it's not that anything changed with how they managed their company. The industry was changing. That's a fundamental change. You wouldn't have been able to see the change that was coming down the road for VHS manufacturers by just looking at their financial sheets, right? You couldn't go to their balance sheet and realize that in 5 years the industry was no longer going to even want VHS tapes, right? And so there are some things that you evaluate from a fundamental standpoint, and then there are some things that you evaluate from a technical standpoint, right? So by and large, this course will be more from a technical standpoint, okay? So anytime you're evaluating a company, you want to be aware of fundamental factors, right? Because fundamental factors can be very influential on the health of a company. For instance, if you were evaluating Apple 10 years ago and all of a sudden you get word that they're going to be launching something called an iPod, right? You may do some research and discover, wow, this looks pretty neat. And so it may not be reflected yet in their financial numbers, but I have a hunch here that iPod may be good. Or when Steve Jobs took over Apple again, that was a fundamental change. And all of a sudden you look and say, wow, they've got the CEO that kind of started everything has come back. Maybe it's a good time to get in, right? And none of that would have been reflected in the technical numbers. When they hired Steve Jobs, they were almost bankrupt. So if you were evaluating Apple at that time on a purely technical standpoint, they would have looked like a bad investment. But looking at them from a fundamental standpoint, then you realize, okay, Apple at that point was starting to look good. So it's not that one is necessarily better than the other, right? But just the focus of this class is going to be more on the technical side of how to look at the health of a company, right? And so in a couple of years after the iPods came out, then you've got some financial data on it, then all of a sudden you begin to look at this company and say this is a company worth keeping, right? That they have turned the ship, right? Because when you use the example of Apple, you might be asking yourself, well, why would anybody even want technical information? It seems like it's behind the times. If I had looked at the fundamental information, I'd have seen that Steve Jobs was coming back. They're coming out with the iPod. I should have been investing on the fundamental and not even worried about this. But that's because Apple's story worked, right? What if the iPod had some glitch or something and it never really amounted to much? Or if it was hard to use or confusing or something, and then some other company came in with a better version and took all the market share that iPod got. The fundamental analysis in that example looks really good because it worked. But just because somebody changes leadership or they have some new product that looks like it might do good doesn't necessarily mean that it will. So fundamental changes sometimes do give you an early warning, but they're not always right. I mean, there's been a lot of examples of companies that have brought in great CEOs, and they were great in another company, and when they got to this company, it still wasn't doing well, right? And so just because there's been a fundamental change doesn't mean that it's going to equate to profits or success. So that's why, by and large, the technical analysis tends to be better, because technical analysis shows you what is really happening, right? What are the real results of the fundamental changes, right? So both are important. It's important to be aware of fundamental changes. But for this class, we're going to focus more on technical analysis, and not really technical analysis. A lot of times if you go and if you bought a book on technical analysis, you're either going to get one of two things. You're either going to get something that's looking at the financial ratios and, like how this class is, understanding financial health. But more likely, the way a lot of investors use this word technical analysis is really about reading charts, right? So we're not going to do that in this class. A lot of people, though, when they say technical analysis in the stock market world, what they mean is, can you look at the stock chart and understand that, right? So that's one form of technical analysis. The technical analysis that we're going to look at, though, in this class deals more with understanding financial documents, looking at the cash flow of a company, looking at the assets of a company, understanding how much return that they have on capital. Are they an efficient company? Do they have too much debt? So things like that are what we're going to look at. All right, so in this kind of first lesson, I want to look at how you value a company, right? What does it mean to place a value on a company, right? How much is a company really worth, right? And so there are two main branches. There's many ways, that you could come up with trying to assign a numerical dollar value to a company, right? Because if we're going to evaluate the health of a company, really what we're saying is how much is the company worth, right? So when you're looking at financial documents and those types of things, you don't know, from an investor standpoint, if you're wanting to invest and buy stock in this company or invest in them, you don't know how much, whether the stock price is a good price or not, unless you first know if the company is worth anything. How much is the company worth? If the company is worth $2 billion, right, then you could take how much it's worth. Theoretically, you could take how much it's worth, divide it by the number of shares that the company has, and you can find out all that information on a publicly traded company. They have their corporations, and they have a certain number of shares, say 10 million shares. And if you know that the company, by your analysis, is worth $2 billion, you could divide that $2 billion by the total number of shares and get a per share price. And if the stock is currently less than that, then maybe it's a good time to get in, because it may revert back to a higher level. Or if the stock is selling for more than what your analysis says that it's worth, then maybe you stay away from that one. And so that is a very basic explanation of value analysis that we're going to get into, is understanding the value of the company right? So that you can then determine if its stock price is attractive to you as an investor or not. Is it something that you say, hey, it's underpriced, I should get in? Or is it something where you look at their financial health and you say, it's not a good time to get in this company. It's overpriced. I'll wait till it corrects back some, and then I may get in, right? And then sometimes when you're using value analysis, you look at their financial numbers and you say, wow, the price is good for this company, but man, look how much debt they have. I don't really feel safe leaving my money invested in a company that has so much debt accumulated compared with the amount of cash flow that they have coming in, and other things like that. So that is the basic idea behind value investing, is you're saying, if I'm going to put my money in a company, I don't want to just know what is their marketing telling me. I want to go and look at their numbers and figure out exactly what is going on, right? But if you don't understand what the numbers are trying to tell you, then looking at their financial information doesn't tell you the story. And so you want to be able to get, because the numbers don't lie unless the people lie about the numbers, which happened with Enron and other places where they actually put in incorrect information into these things so that people who are looking to invest in the company would have a distorted picture of how valuable the company was. And so that was behind the collapse of Enron, was that the numbers they were reporting to the public were incorrect. And so if you were an investor, you'd look at that and say, well, this is a decent investment. It's not great, but in fact, Enron wasn't really that great of an investment. It was average. And that was their lying numbers, were average. The actual numbers were, they were going bankrupt. And so they manipulated the numbers and made it look like they were at least an average company, right? And they had a bunch of hype surrounding them about what they might possibly do in the future, fundamental analysis, right? And so you got a lot of people that were investing in them. And so whether you were a technical analyst and you looked at the numbers they were reporting, or if you were a fundamental analyst and you looked at the hype they were producing through their marketing, either way, they looked at least to be a safe bet. But the truth is they were lying about the numbers. And so they weren't. They were about to go bankrupt. And when they couldn't hide it anymore, whistleblowers and things, it just got to the point where they couldn't hide it anymore and the truth came out, it was too late. There was not enough assets in the company to make it worth anything, and all these people that had invested essentially lost their investment. And so as long as the company is telling the truth about the numbers, and you have learned how to read the numbers, then you can get a pretty good picture of the company by looking at their financial analysis. Because in today's world, you can hire somebody who is great at making a website. You can hire somebody who's great at making a commercial. But that doesn't mean that the executives of the company are managing the company in a profitable way. What if they're spending, what if they're in a building where the rent on their facilities is eating up all their profits? Or what if they started off with so little cash and they had to go into debt to get everything they have, and the interest that they're paying on the debt is keeping them from really being profitable? They just have a great website and a catchy commercial, right? And so you don't want to be in the position of investing your money in a company based on their commercial and their website, right? That may factor into it, because if you don't have a good commercial and a good website, maybe you're not going to do well long term. But that shouldn't be the only part of your analysis if you're going to invest your money. You want to have a more technical approach and look at what the company is doing with what they have in the financial part of their company, right? Okay. We probably all heard stories, just to give you a kind of a real life example, of maybe somebody that's driving a Mercedes, but they live in a trailer, right? And so if all you do is see them out on the street, you think, man, they must be really raking in the money. They must be very successful, because the part you see appears successful. And then they pull in to some rundown house, and it's not that there's anything wrong with trailers, but if you look at the value of a trailer as compared with the value of a brand new Mercedes, they don't fit. The image normally that you would get of someone driving a Mercedes is typically someone that has a whole lot of money, and that's why they're able to afford the Mercedes. But then you begin to realize that Mercedes is almost all of their income, right? They probably shouldn't have the Mercedes for the amount of income that they have, right? And so if you follow them home, then their house is falling apart, it's run down, they're not repairing their house because everything they make is going into paying their car payment. You follow them home, you get the real story, right, of how they're managing their finances. And in the same way, companies do the same thing sometimes. The Mercedes, what you see in public is their marketing, right? So they put a lot of money into a fancy web page. They put a lot of money into getting their name out there. They put a lot of money into their website and their commercials and their radio ads and all that kind of stuff. But if you follow them home, right, and you see what they're doing with the rest of their money, maybe they're really in debt. Maybe they don't have much assets. Maybe they haven't, been able to be efficient, and so it's costing them a whole lot of money to make each one of their products or whatever it is. And then all of a sudden, you get the full story. Now, sometimes you follow the person in the Mercedes home, and they're in $1 million mansion. And then all of a sudden, you look at it and you say, okay, they probably do have decent income, right, if they've got both. And even that doesn't tell the full story, because there's a lot of people that lost their homes because they were in mansions that they couldn't afford. But you get the idea that just what you see, the performance or show that someone puts in public does not always reflect what they have in private. And so in the same way, businesses are that way, that many times they know that you will evaluate them predominantly on what you see. Right? Most people don't take this extra step of going in and reading the numbers. And so they know that the average consumer is going to evaluate them based on what they see, and so they put most of their money into marketing and websites and things of that nature, which is smart financially, right? I mean, that is a good way to approach it, but before you put your money into that company, you want to be able to make sure that they are stable financially, right? And so the only way to do that is to go back in and look at the numbers. And so I want to talk about the two kind of more common, broad ways that you could evaluate a company, right? One of them is centered more on forecasting. The other one is centered more on what we're going to call value investing, right, which is the thesis of this class, right? So the one for projecting, basically, what you would have to do is you would try to evaluate the company based on their current cash flow, right? All the cash they will produce, right, for the life of the company. And this sounds like a really good way to evaluate what the company is worth, right? That you want to know, I mean, the point of the company is to produce positive cash flow. And so one way of evaluating how much a company is worth is to say how much cash will it produce over the life of the company, right? And so that is, that is one way to understand value. And it's actually a very common way. A lot of investors use this. But there are some flaws in this thinking, right? One of the main flaws, perhaps the main flaw of this, is found in this word life, the life of the company. The trouble with trying to determine how much a company is worth by thinking about how much cash it's going to produce over the course of its life is that you don't really know what's going to happen in this company in 5 years, right? I mean, you don't know what's going to happen in this company next year. If you were, because basically what they would do is they would look at, say, the average cash flow that the company has had up to this point. So say if the company's been in business for 7 years, one way to evaluate this is to take an average cash flow over those 7 years, right? And then you extrapolate that forward, taking into account the rise of inflation. So you may add 3 to 5 or so % onto it each year for inflation, because as the price of everything goes up, the price of your service will go up too. And so then the amount of cash coming in will actually be more down the road. So you could look at that. You adjust for inflation. So a lot of times what you have to do is, if you just want to know strictly how much cash is going to come in, you may add that 3-something%. If you want to know how much its spending power is, you may want to subtract the 3-something%. But that's a whole other thing that we'll get into later. Because the more that the price of things goes up, the less spending power each dollar actually has. So down the road, what you have is not going to spend like what you have today. But anyways, there's some complicated formulas that you can use to create what's called future value, right? And we talk about this a lot in the financing course that we have here: future value, present value, right? And so present value looks at how much a company is worth right now based on what it's going to be in the future, right? And then future value, so you want to say if somebody was going to purchase a company, they would want to know how much is the company worth today, right? So that's present value. And then future value extrapolates that out, and you want to know what is the company worth down the road. But the main thing that I want you to get out of this, we're not going to go into the financing part of it, that's a little different from what we're going to cover in this class, is that they would then want to say in the future, through using various methods of calculation, right, of extrapolating out over the next 10, 15, 20 years, whatever, what this company is going to take in its cash flow based primarily on what they've done up to this point, right? And sometimes this works and sometimes it doesn't, because the trouble is that what they've done in the first 7 years really doesn't mean that that's what they're going to do in the other years. I mean, it seems like that's a good way to evaluate it, but it's really not. Because take the VHS example, or even the Apple example. In the VHS example, within 5 years, the market crashed almost for those. And so if you had been trying to evaluate the value of a company in the VHS industry, and the crash hadn't happened yet, you would be way off, right, in what you were paying, because the industry itself collapsed. Same thing with Apple. They were bankrupt when Steve Jobs took over. So if you looked at their financial stuff, extrapolated out, it's not a very valuable company. But we know in reality it became a very valuable company, right? And so the trouble is with taking an approach like this, where you evaluate a company based on the amount of cash you think it will produce over its life, and that's what you think it's worth, is that it really doesn't hold true often enough, right? And so the other approach to evaluating how much a company is worth is not to project out into the future, right? A more appropriate way is what we're going to call value investing, right? Value investing. And the idea behind value investing is that you want to look at a snapshot of the company today. What does the company look like today? How much assets do they have? And what is their cash flow? Those are the two main things. Their earning power, right? Cash flow. When I say earning power and cash flow, those are very similar. How much cash can it bring in right now, right? Don't tell me in 3 or 4 years we're going to be fine, everything will work out, because it may not. It very well might work out in 3 or 4 years, but the truth is that's too much of a variable if you're going to invest your money, right? I mean, they may be right, but that doesn't mean that you want to invest your money in that, and that's a decision you'll have to make. But if you're going on a technical analysis, you want to see it turn around a little bit first, right? And so value investing then says that the better way to evaluate how much a company is worth is not to try and make assumptions and guesses about 5 and 10 years down the road to come up with a number for today about how much it's worth by extrapolating out what it will produce over the next 5 or 10 years and saying that's how much it's worth. Value investing says, let's look at where it's actually at today and come up with a number based on what it is at right now. Okay, and so that's value investing. And so if you're going to evaluate what a company has right now, then the number one thing you're going to be looking at are assets. What assets does the company have, right? Do they have cash? Do they have land? Do they have equipment? Do they have inventory? Do they have raw materials, supplies? What types of other investments do they have? Do they have a lot of bonds? Do they have, a lot of their own, whatever the company has invested in? Maybe they've got, apartment complexes and they're producing income or whatever it is. They can have, because you could be any kind of business and invest in other business opportunities, apartment complexes, housing rental, things like that, corporate office space that you lease out. There's many ways to produce on an investment. And so a lot of this stuff falls under the asset category. And then almost conversely, you would just want to compare that a little bit with their debts, their liabilities. Because, if you only take a snapshot of just the assets, you say, wow, they've got 10 million in assets. But if they have 100 million in debt, then all of a sudden that 10 million, which if it's just sitting by itself, seems very strong. But if you compare it with the amount of liability that they have, then all of a sudden they're on shaky ground then. And so you want to fill out the picture with liability. And then the other thing is earning power. Cash flow. Right. How much are they bringing in on a monthly basis or annual basis, however you break it down? But what is their cash flow? Their cash flow is a very important barometer of health, right? No matter how much you have in the bank, if you have no cash flow, then it's still not a healthy company. So you need both of these elements to create a clear picture of the value of the company. And so this is a very basic introduction, but it does set the stage for us to discuss in future lessons maybe the nuances a little bit of value investing. But this is the general idea, is that it is better to evaluate a company based on what they are doing right now, right, as opposed to trying to forecast down the road what they are going to produce. And so in order to evaluate what they are going to do now or where they are at now, you need to be able to look at their assets and liability and their cash flow, right? And so if you remember from the accounting class, these are very familiar words to you, right? Because these are the words, this is the language of financial statements. And so if you're going to be able to succeed in value investing, you've got to be able to read the financial statements, because therein is the description of how the company is doing right now. So that's why your textbook for this class is kind of a rehearsal of how to read these financial statements, right? And that will help you. So if you can read them properly, which is what the textbook is trying to show, then you can come in with your value investing approach and be able to evaluate a company effectively, because you're not going to be able to do this part of it if you can't read the statement, right? So reading the statements is a skill. Value investing is a process, right? And one of the skills in the process is being able to read your financial statements, okay?